The Hidden History of Banking, From Temples to Wall Street. Section 1. Introduction and Ancient Beginnings. So here it is. Before we dive deep into Wall Street, trillion-dollar bailouts, and modern credit systems, we need to step back, way back. Because the story of banking didn't begin with glass towers in New York or billion-dollar corporations. It began thousands of years ago, when humanity was just figuring out how to farm, trade, and store wealth. The history of banking is almost as old as civilization itself. Wherever you find organized societies, you'll find people worried about two things: how to protect what they have and how to borrow what they need. And out of that tension, banking was born. The first recorded evidence of banking dates back to ancient Mesopotamia, around 2000 BCE. Here, merchants provided grain loans to farmers who needed seeds to plant or tools to harvest. Temples in Babylon weren't just places of worship, they doubled as the first banks, storing valuables, recording debts, and even issuing loans. Think about that. The same priests who offered prayers also kept your gold safe and charged you interest. The Code of Hammurabi, written nearly 4,000 years ago, even included laws about financial transactions, interest rates, and collateral. This wasn't guesswork. This was a structured system. If you failed to repay a loan, there were rules, and sometimes very harsh punishments. In other words, our ancestors already understood the need to regulate finance, and they built surprisingly sophisticated systems. And Mesopotamia wasn't alone. In ancient Egypt, temples acted as secure vaults for grain and precious metals. Farmers and traders deposited their harvest, and priests recorded withdrawals like today's ledgers. Ancient Greece brought moneylenders into the marketplace, where coins could be exchanged, loans secured, and wealth managed. But perhaps the most influential of these early systems came from Rome. Roman bankers, known as argentarii and mensarii, set up their stalls right in the Forum, the bustling center of commerce and politics. They offered loans, facilitated payments, and managed deposits. In fact, many of the Latin terms they used would later form the foundation for our modern financial vocabulary. By this point, banking had moved beyond temples and shrines. It was becoming a profession. Roman bankers dealt with traders, soldiers, and even emperors. They weren't just moving coins from one hand to another. They were funding wars, expanding trade, and building infrastructure. Banking had become the lifeblood of empire. But then, as Rome fell, banking fell with it, at least in Europe. For centuries, trust in financial institutions disappeared. Yet the idea of banking never really died. It survived in the Byzantine Empire, thrived in the Islamic world, and re-emerged during the Middle Ages in ways that would forever reshape history. And that's where our story goes next. Medieval banking and the rise of modern finance. When Rome collapsed, much of Europe's financial structure collapsed with it. Trade shrank, coins disappeared from circulation, and for centuries people went back to bartering goods directly. But in other parts of the world, banking never truly stopped. In the Byzantine Empire, banks continued to function, backed by the wealth and stability of Constantinople. The Byzantines carried forward many Roman financial traditions, including currency exchange and loans. Meanwhile, in the Islamic world, an entirely new system of banking and finance was developing, one guided by religious principles. Islamic banking, for example, prohibited charging interest, known as riba. Instead, they created profit-sharing arrangements and credit systems that allowed commerce to flourish across the Middle East, North Africa, and into Spain. By the Middle Ages, these systems connected East and West, laying the groundwork for international trade. But Europe wasn't entirely without innovation. By the 12th century, something extraordinary emerged: the Knights Templar. Not just warriors, but bankers. Pilgrims traveling to the Holy Land could deposit money at one Templar outpost and withdraw it at another. In effect, the Templars had created one of the first international banking networks. Their reputation for honesty and discipline made them trusted custodians of wealth, not only for travelers, but also for kings and nobles. Some historians even call them the world's first multinational financial corporation. But the Templars weren't the only ones shaping medieval finance. Italian city-states like Venice, Florence, and Genoa were becoming powerful trade hubs. With merchants sailing across the Mediterranean, the need for credit, loans, and currency exchange exploded. Families like the Medicis in Florence rose to prominence, creating banking dynasties that changed Europe forever. The Medicis weren't just bankers, they were innovators. They developed double-entry bookkeeping, a system so efficient that it's still used today. They managed accounts for royalty, funded trade expeditions, and even financed the Vatican. Their banking empire made Florence one of the wealthiest cities in Europe and fueled the Italian Renaissance. Art, science, and culture blossomed because bankers kept the money flowing. And this is where banking began to resemble the system we recognize today. By the 1600s, Europe saw the birth of central banks. The Bank of Amsterdam, founded in 1609, became a model of financial stability. The Swedish Riksbank, established in 1668, is recognized as the first true central bank. And in 1694, the Bank of England was founded, a giant in the history of finance. These institutions weren't just safekeeping deposits or issuing loans. They were regulating the money supply, issuing banknotes, and supporting governments. The shift was clear. Banking was no longer just about merchants and families. It was becoming a structured, institutional part of the state. This transformation laid the foundation for the financial revolutions of the coming centuries, revolutions that would accelerate with the Industrial Revolution and forever change how economies functioned.
The Industrial Revolution, the gold standard, and the birth of modern banking systems. The dawn of the Industrial Revolution in the 18th and 19th centuries changed everything. Not just how goods were produced, but how money moved. Suddenly, industries needed massive amounts of capital. Factories, railways, steamships, and later electricity. All of these projects required more financing than traditional family banks or local lenders could handle. This era saw the rise of large commercial banks that specialized in raising capital for industry. Investment banking began to emerge, with firms helping companies sell shares of stock to the public. For the first time, ordinary people could invest in the growth of industry. Finance was no longer just for kings and merchants, it was becoming democratized. At the same time, nations sought stability in trade and currency. Enter the gold standard. By the mid-1800s, many countries pegged their currencies to a fixed quantity of gold. This meant that paper money could, in theory, be exchanged for actual gold at a set rate. The system created trust and consistency across borders. A British pound or an American dollar wasn't just paper, it represented something tangible. The gold standard helped global trade explode. Banks became central players in facilitating international commerce, managing letters of credit, and ensuring payments moved securely across oceans. London, in particular, rose as the world's financial capital. Its banks funded projects not only in Europe, but in Asia, Africa, and the Americas. But banking wasn't only growing in Europe. In the 19th century, the United States was a turbulent time for finance. Banks were being chartered and collapsing at an alarming rate. There was no central bank to stabilize the system, leading to repeated panics where banks failed and people lost their savings overnight. Only in 1913, after decades of instability, was the Federal Reserve System created. The Fed became America's central bank, tasked with regulating the money supply and acting as a safety net during financial crises. Meanwhile, industrialization and banking went hand in hand. Without banking, there would have been no railroads spanning continents, no vast steel mills, and no Greek shipping empires. But without industry, banking would have remained small and local. The two forces fueled each other, creating the foundation of the global economy we recognize today. By the late 19th and early 20th centuries, the world was deeply interconnected financially. A decision made in London or New York could ripple across the globe. For the first time in history, finance wasn't just local, it was global. And yet, this growing interdependence came with risks. When crises struck, the shockwaves spread everywhere. Soon the world would discover just how dangerous this could be. The Great Depression, World Wars, and the birth of modern financial regulation. The early 20th century was a turning point for global finance, a period marked by both extraordinary growth and devastating collapse. The roaring 1920s brought stock market booms, speculation, and almost religious faith in endless prosperity. Across the United States and beyond, people poured their savings into stocks, often with borrowed money. Banks themselves were deeply involved, lending freely to speculators and taking dangerous risks. It felt like the good times would never end. But on October 1929, reality came crashing down. The stock market collapsed. Billions of dollars evaporated in days, leaving banks insolvent and millions of ordinary people without savings. What began as a market crash spiraled into the Great Depression, the worst economic crisis in modern history. Banks failed in staggering numbers. In the U.S. alone, nearly 9,000 banks closed their doors between 1930 and 1933. Trust in the financial system collapsed. People hoarded cash under mattresses because banks were no longer seen as safe. Governments were forced to act. In America, sweeping reforms reshaped the financial world. The Glass-Steagall Act of 1933 separated commercial banking from investment banking, ensuring that the risks of speculation could not endanger ordinary deposits. The Federal Deposit Insurance Corporation was created, guaranteeing people's savings up to a certain amount. For the first time, bank deposits felt secure. Meanwhile, Europe was descending into turmoil. The financial devastation of the First World War, compounded by heavy reparations imposed on Germany, destabilized the continent. Hyperinflation in the Weimar Republic destroyed middle-class savings overnight. A loaf of bread that once cost a few marks skyrocketed to billions. Currency became worthless paper. This chaos helped fuel political extremism and the rise of fascism, proving that finance and politics were inseparable. The Second World War reshaped the financial order once again. Funding a global war required unprecedented borrowing. Governments sold war bonds, mobilized national banks, and tightly controlled financial systems to keep economies focused on the war effort. But perhaps the most important outcome of the war was what came after, the Bretton Woods Conference of 1944. Here, world leaders designed a new financial system to stabilize global markets. The US dollar, backed by gold, became the anchor currency of the world. Institutions like the International Monetary Fund and the World Bank were born, designed to prevent the kind of financial collapse that had fueled depression and war. This era of regulation, stability, and international cooperation laid the foundation of the modern global financial system. Banks were more heavily supervised, deposits were safer, and the US dollar became the central pillar of world trade. Yet as stability returned, seeds of future challenges were being planted. Tying currencies to gold would eventually strain under the pressures of a growing global economy. And as financial innovation resumed, risk would once again creep back into the system.
The rise of global finance, deregulation, technology, and the digital revolution. By the late 20th century, the world had entered a new era of finance. The post-war stability that Bretton Woods had created began to waver. In 1971, The United States abandoned the gold standard, ending the era when currencies were directly tied to gold. Paper money became fiat currency, whose value relied entirely on trust and government backing. This shift gave central banks more flexibility to manage economies, but it also introduced new risks. At the same time, financial markets were growing exponentially. Globalization, trade liberalization, and technology allowed banks and investors to operate across continents faster than ever. Derivatives, complex investment products, and multinational corporations transformed banking from a local service into a global network of interdependent markets. Financial centers like New York, London, Tokyo, and Hong Kong became hubs where trillions of dollars moved in mere seconds. Deregulation in the 1980s and 1990s unleashed massive innovation and risk. Investment banks began taking on ever larger speculative positions. Mortgage-backed securities, credit derivatives, and other instruments promised high returns, but they were often poorly understood and highly leveraged. The 2008 global financial crisis exposed just how fragile the modern system could be. A collapse in the U.S. housing market triggered a domino effect, sending banks into insolvency and governments scrambling to save economies. Trillions of dollars of wealth were wiped out almost overnight. Yet the digital revolution also brought incredible opportunities. Online banking, mobile payments, and fintech innovations transformed how people interact with money. Cryptocurrencies emerged, challenging traditional notions of banking and central authority. The world's first fully digital currency systems offered speed, transparency, and accessibility, though they also introduced debates about regulation, security, and trust. Today, banking is both older and newer than ever. Its roots stretch back thousands of years, from Mesopotamian temples to medieval Templars, Renaissance dynasties, and early central banks. And yet, the modern financial world is dynamic, fast-paced, and interconnected on a scale that our ancestors could hardly imagine. Technology, regulation, globalization, and human innovation continue to shape the system in ways both exciting and precarious. Understanding the history of banking is more than an academic exercise. It's a roadmap for understanding risk, opportunity, and the forces that shape the global economy. Every loan, investment, and policy decision has echoes in the past. By looking at how banks evolved from simple repositories of grain to digital financial powerhouses, we gain insight into both the potential and pitfalls of finance today. So, what does the future hold? Will banks evolve into fully digital institutions? Will cryptocurrency replace traditional money? Or will global regulation strengthen and stabilize markets? One thing is certain. Banking will continue to influence every aspect of our lives, from personal savings to international trade. Thank you for joining us on this journey through the hidden history of banking. If you enjoyed this deep dive, make sure to like, subscribe, and leave a comment with your predictions for the future of finance. We're always excited to hear your thoughts, and we'll see you in the next video as we continue exploring the fascinating world of money and banking. Now that we've traced banking from ancient temples to modern Wall Street, it's clear that banks are far more than just buildings filled with money. They are the lifeblood of economies, connecting people, businesses, and nations in an intricate web of trust, credit, and innovation. Every coin exchanged in Mesopotamia, every note signed by the Medici, every digital transaction today contributes to a system that has evolved over thousands of years. Understanding the history of banking helps us see that financial crises, innovations, and regulatory shifts are not random. They are the natural outcome of a system built by humans, for humans, shaped by culture, war, commerce, and ambition. Banks have always been mirrors of society, reflecting both our ingenuity and our vulnerabilities. As we look forward,
The future of banking will likely be even more intertwined with technology, digital currencies, and global interconnectedness. But no matter how advanced the tools or sophisticated the algorithms, the core purpose remains the same: to facilitate trust, manage risk, and enable growth. So, the next time you deposit money, swipe a card, or invest online, remember that you are part of a story that spans millennia, a story of risk, reward, innovation, and human ingenuity. Now, we'd love to hear from you. How do you think banking will evolve in the next 50 years? Will AI and cryptocurrencies reshape it entirely? Or will the lessons of the past continue to guide the system? Share your thoughts in the comments below. Thank you for watching, and if you enjoyed this deep dive into the hidden history of banking, make sure to like, subscribe, and hit the notification bell so you won't miss our next journey through the world of finance and banking. We'll see you back here tomorrow for another fascinating story.